Good day, ABM Business Finance learners. In this video, we will going to discuss the sources and the uses of funds. Before we proceed, let us define the following terminologies. Financial institution, it is an intermediary between the consumers and the capital or debt markets providing banking and investment services. Bank, it is a financial institution licensed to receive deposits and make loans. Non-bank, it is an institution that is not a bank but engages in certain banking practices as lending money or holding deposits. One of the essential components of a successful business is a constant flow of funds. This is considering that flow of funds is part and parcel of every business cycle. Funds are truly the lifeline for any company. What are the sources of funds or capital? We have two, that is, from equity or capital stock financing, and the other one is from borrowings. Let us see the comparison between the equity and borrowings in raising funds. In equity, the company is not required to pay dividends to ordinary shareholders because payments of dividends is at discretion of directors. Therefore, if a company suffers a decline in profitability or is short of cash, it can omit the payment of dividends without any serious consequences. While in borrowings, companies or borrowers will have to pay regular interest payments and principal amount at the maturity. Failure to pay will almost certainly have serious consequences and can ultimately lead to a company being placed into liquidation. In equity, ordinary shares do not have any maturity date, but in borrowings, we have maturity date. In equity, the higher the proportion of equity in a company's capital structure, the lower the risk the company will suffer losses. In borrowings, higher risk to suffer risk as a result of the borrower experiencing financial difficulty. In equity, if the company issues more stocks or ordinary shares to raise capital, existing shareholders will have to outlay additional cash or suffer some dilution of their ownership or control of the company. But in borrowings, it allows funds to be raised without dilution. Where the company use their funds? First, to develop a new product or service or make improvements to the existing products. Number two, to start its operation or convert its idea into reality. Number three, to expand its operations. Number four, to buy a new property or new machinery and equipment. To complete any big order which otherwise would have been impossible to complete. For research and development activities. For their working capital requirements. And last, for debt structuring. The question that arises as to where and how a business acquires funds for its operation if they choose to borrow, the answer would be there are lots of banks and non-bank institutions in the locality which can serve as a source of funds. Banks and non-bank institutions. Banks are financial establishments where the money deposited by customers earns interest and can be withdrawn anytime when ordered by the signatories. To be able to pay for the interest for the money entrusted by the depositors, banks invest it to a financial instrument or extend loans to borrowers. Non-financial institutions are also financial institutions that can provide fund requirements of the business, but their operations are not supervised by the national or international banking regulatory agency, or they have no full banking license. Banks and non-banks are basically the sources of funds of borrowers, whether individual borrower or a company. Sources of funds, either short-term or long-term, offered by banks and non-banks to their clients should be processed and supplemented by legal requirements mandated by the Bangko Sentral ng Pilipinas. At this point, let us study the loan and its requirements. What is loan? A loan is a financial arrangement where a borrower who receives money from a lender agrees to repay the principal along with interest within a specific period of time. The loan interest rates vary significantly based on the type of loan repayment terms, and the borrower's background. Before a bank or non-bank institution approves a company or individual borrowings, consideration of 5 Cs of credit is being evaluated. What are these 5 Cs of credit? 5 Cs of credit are character, collateral, cash flow or also called capacity, capital, and conditions. Character is the borrower's willingness to repay the loan, his or her integrity, and stable employment. It also talks the length of current employment plus the experience and performance in the industry. All in all, it is the borrower's overall stability. Collateral is any asset you own that you can pledge in the event you cannot repay the loan. Often lenders will also ask for a guarantor, someone who agrees to pay the debt if you cannot. They also assess the property type, its location, and marketability. The next one is the capacity or cash flow. It is basically your ability to repay the loan. What is your debt to income ratio? And what is the cash flow from your business? Next, we have capital. Capital is the borrower's overall net worth. That's the value of what the borrowers own minus the amount he owed. Capital also takes into consideration the amount you have personally invested in the business and how much skin you have in the game. Last, we have conditions. Conditions takes into consideration the environment of the loan, what's going on in your industry and with your competitors. What's the intended use for the loan? Conditions take a look at the outside forces impacting the borrower's repayment ability. By knowing the 5 Cs of credit, the borrowers can prepare for what is needed during the approval process of a loan. In addition to knowing that each characteristic is, it is important to know how banks and lenders will use this during the application and approval process. We have 3 types of loan, and these are personal loan, housing loan, and auto loan. Personal loan may or may not require any form of collateral as security payment. It is also called as character loan. Banks may also grant personal loan equal to or less than the deposits of the borrowers as an example of any form of collateral. The two types of personal loan are secured and unsecured. A secured loan requires the borrower to have some sort of collateral as payment security for loan lenders. Unsecured personal loan refers to a personal loan without collateral, but this often comes with a higher interest rate. It is also considered risky due to the absence of any form of security. Housing loan. This housing loan is availed either for buying a real estate for dwelling purposes or for house construction or renovation purposes. This can also be used for refinancing an existing house loan. The third one is auto loan. Ways by which consumers can make use of an auto loan. First, to purchase a new or used vehicle through bank financing and pay it back for a specific period of time, which is usually in equal monthly amortization of principal and interest. Number two, reimburse the cost of a brand new vehicle within 30 days from purchase. Number three, get cash loan by using your existing car as collateral. Number four, refinance an existing auto loan. Auto loan is easily approved if the potential buyer has a proof of good credit score from a bank or preferred financial institutions. A good credit score will show the capability of the borrower to pay on a schedule based on previous loan records, and interest rates and the monthly installment payments will be dependent on the amount of the required initial security deposit and payment terms. The following are the eligibility requirements of the banks and non-bank institutions. Thank you.